Let's do a deeper dive on China banks and bring in Shujin Chen, now China economist and head of China financial and property research at Jefferies. Shujin, thank you for joining us. Despite the stimulus program that we know now, why do you have underperform ratings on all the major China banks?
Well, actually, I think the underperforming, from my perspective, is that the underperforming is actually not for all China major banks. In fact, the big four banks, including the, especially like SOE banks, they are our top pick among financial and property sector this year. But we are just the least favored those banks amid market rebound. So to clarify is that most of the time in this year, we actually like China banks, but only during the market rebound, we will switch to other like high beta names. And since we are relatively positive in short term regarding to the market till the year end, assuming potential stimulus and also considering that now the capital market become a KPI for China government. So during these days, banks is not our favorite at this moment in short term.
Hi, Shujin. One of the reasons why investors, particularly domestic institutional investors in China, like to buy the banks is because of the high dividends. And so there's a lot of question about the sustainability of banks' ability to pay dividends. Any thoughts on that, given the recent dynamics?
Sure, yeah. We can see that from the third quarter that banks are still trying to have a flat year-on-year change in the profits. For example, like for all the big four banks, almost if you look at the accumulated profit growth this year, it's largely flat year-on-year for the 9 months till now. So although we think it's still quite challenging for the full year, because in the fourth quarter the net interest margin would be more challenging in the third quarter, given the cut in the mortgage rate, as well as like more decline in the LPR. But still, we see the banks are trying to fight for a flat profit year-on-year. So in general, China banks, those like large SOE banks, their profit growth is slightly slower than China's nominal GDP growth. And we still believe that China's nominal GDP growth can grow positive this year and next year. And therefore, for banks, they are still able to deliver a relatively stable or largely flat year-on-year growth in terms of the profits. And for large banks, they're also trying to keep the 30% dividend payout due to the KPI metrics for them. 30% is kind of like the full score for the SOE banks. And in China, the SOE banks, they actually act quite similar. All of them, they act quite similar to each other. It's very hard for one of them to change the dividend payout. So we actually think that the dividend payout DPS per year, DPS will be largely stable in the next 1 to 2 years.